Hello, welcome to everyone. My name is Antonio from Trade Tech, and with this new video, we are going to discuss and to show you a number of things. One of the things are the some of our real performance, few trading strategy, and the aggregation in the portfolio. Because it's always nice to discuss good back tests, good equity line, but it's also important to show how the things are going in real trading with the live account. So in this case, we're gonna show you a few strategy which have been developed by very good guys who are our developer Pratap and Sajid. They are expert, easy language expert, and portfolio manager expert in general. We have developed we have a number of strategies, by the way. I'm gonna show you some strategy developed by these two guys. We have other strategies on different instruments. Some of them have been developed by myself, and we show you the portfolio and the second portfolio, some real performance. Because that the purpose of this video is that depending on your account size requirement, we can offer you a number of strategy, different portfolio, depending on the account size that you have. For this client, the account size is very small, and he started with $10,000, and after 3 months, June, July, August, you see the final result is already very good. So, first of all, just few words regarding the strategy themselves. We have, which actually it's our approach. We always prefer to aggregate different strategy with different logic on different instruments. In the case of the strategy developed by Pratap, we have here crude oil 4 hour. Then we have another with a different logic, swing and open breakout. Crude oil 15 minutes, gold 1 hour, eating gold 15 minutes. And I want to show you there are a number of benefits we can discuss when every single strategy is aggregated in one portfolio. In this case, I want to show you one of the main advantage, which is the maximum drawdown percent. But first of all, let's see what are the real performance of one of our customers. This is the people who know TradeStation. They know that it's possible to, which is, by the way, a feature of every platform, every broker. You can extrapolate the performance, the track record, live trading by month into a PDF. For obvious reason, we have covered here the personal data for privacy. This is a report from one of our customer, and we see here from beginning of June this year, trade by trade, the entire track record. It started with a quite small account, $10,000, and at the end of June, we are here. Well, it started in June with 1100, was 10,000 from the beginning, and in June the profit and loss was 2000. Then we moved to July, and this trading instrument that I show you, heating oil, gold, crude oil, and so on. We go to the end of July. In July, profit and loss is quite small, it's less than 400. And then we go to August, same instruments, intraday trading, gold, eating gold, and so on. And end of August, we end with the profit and loss of August, which is more than $6,000. So at the end of August, the ending balance is almost $20,000. So starting from 11,000, we have roughly an increasing of the account of roughly 80%, which is by the way a good result, obviously. Just few words regarding the strategy that we are trading live. What I want to show you in these, those are the same trades that are working live. And here you see the aggregation of every single strategy in one portfolio. As I said, there are a number of benefits when you aggregate different strategy over different markets and different instruments and time frame. Let's assume to start for every strategy with the same account size. For instance, $100,000 for crude oil, gold, and heating oil. And also, when we aggregate all this strategy in one portfolio, let's assume to start with the same initial account, 100,000, 100,000 dollars. You might notice that when you take the strategy singularly, you have a certain max drawdown percent. In this case, you see 11%. Crude oil here is almost 5%. Gold is 7.6%. Heating oil is 7%. But when they are aggregating all together, the maximum drawdown is roughly on average 7.6%. So you don't get this high amount, which I noticed in gold, where it is 11%. I saw somewhere, yeah, here. So, and the reason is very simple, because you are using different instruments and working on different time frame. It's very unlike that you have same drawdown over over different strategies. This is one of the main benefit that we want to show you here, but there are other tests, other things that we can discuss later. By the way, once again, we show you an example of live trading with a very small account, but of course, depending on your account size, we can offer you other portfolio, even bigger or smaller if you want. Or if you prefer some other instruments, we can discuss with you. So don't hesitate to have a look to our website, and if you need some extra information, you have here a contact form, or just send us an email and we try to meet your requirement. But let's focus on another portfolio just to show you as another example here. Once again, we always like to use different markets, such as, well, by the way, so commodities, currencies, and indexes. So here we have, just want to show you some backtests, some equity line, sugar with a time frame of 500. By the way, was almost forgetting. Once again, the logic is slightly different from instrument to instrument, from strategy to strategy. You might have a trend following or a volatility breakout in some cases, or swing logic, and the time frame as well is slightly different from the intraday to the daily and other intraday time frame. So let's quickly review the equity line. Don't want to bore you with every single metrics, but once again, if you are interested to a specific strategy, a specific instrument, specific portfolio, just send me an email and we try to understand what are your needs. So here, for instance, we have sugar 500 minute, feeder cattle 45 minute, frozen concentrated OJ 100 minutes, cocoa 60 minutes, and then from commodities we move to the currency such as Canadian dollar. In this case, the time frame is daily. Australian dollar, again daily. We always like to show the intraday, the day by day equity line, because you never know what's going on with the with single close trade equity lines. So that's why we always prefer to show you the day-by-day equity line. So we're saying we have currency daily, uh, mini Euro FX, Euro FX, in this case intraday 60 minutes, E-mini S&P mid-cap 400. So we are now moving to the indexes. Mini Russell 2000, very short time frame, in this case 5 minutes, takes a while to load. Then mini Nasdaq 1 hour time frame, and of course you cannot miss Mr. Mini S&P 60, in this case 1 hour time frame. All this strategy once again had been aggregated in one portfolio. So you see here, using this software, we think it's very good, by the way, MSA, because you can not only aggregate in a portfolio, you can make some tests regarding the position size we are using. Because by the way, here we supposed to trade only one contract. I almost forgot to tell you, even the other portfolio as well. We are trading one contract per trade. So if you decide to, if you feel confident that you want to reinvest the profit, you might decide to change the position sizing, and you have a number of position size that you can change, you can decide with this instrument. But that's not what we want to show you in this video, maybe in another one. So here we see the same strategy that you saw before into TradeStation. And once again for feeder cutter, you see max drawdown percent, which is almost 10%. OJ more than 5%, EMD 4%, Sugar almost 4%. But when all these strategies are aggregating into the portfolio, you see immediately how the maximum drawdown percent of the entire portfolio is landed 4%, for the reason that I have already explained, because it's very unlikely that so many strategies are facing the same drawdown in the same moment. That's the first, really the first beneficial thing. But I want to show you some other tests as well. Let's focus on one of the strategy we have shown before. We see here that max drawdown percent from historical trade is more than 9%. But if we run a Monte Carlo test, Monte Carlo analysis, we see here that with the 95% of confidence, the maximum drawdown can be even more than 60%, or even more, with 95% of confidence. So remember this number. With 95% of confidence, 60% is the maximum drawdown percent for feeder cattle. But now if we do the same test over the entire portfolio, so I'm running here a Monte Carlo analysis. It takes a while because there are many. Oh, excuse me. There was a different setup here, so we do it again. We are running a Monte Carlo analysis, and we notice here that in this case the maximum drawdown percent with the 95% of confidence is less than 7%. So it's over the entire portfolio with the 95% of confidence, we have a maximum drawdown percent of 6.5%, while for the single instruments feeder cattle we showed you before can be 16%, right? Remember, I'm running again the same test here. It's slightly different because every time you run a Monte Carlo analysis, you make a different random aggregation of the trades, of the single trades. So that's one of the things that we might discuss here. We come back to the normal sequence. We can make some other tests over the entire portfolio here, such as randomize the trade order, and you see the portfolio is still robust. Or we can do the same test over the other portfolio as well. It's exactly the same, so I don't want to duplicate the same concept. There are also another interesting tests you can, just because I want to show you the robustness of the entire portfolio, not only focusing on the max drawdown percent, which by the way from our perspective is one of the most important tests to do, because hey, doing profit is something that's easy to manage. What you really need to focus and manage is the max drawdown percent that you should expect. Sorry, I forgot to specify, even in this case we are using the same starting account of, just to make a very easy example, of $100,000 for the single strategy as well for the portfolio, because just that's because I want to show you how what's the benefit when you aggregate into portfolio and we focus on the maximum drawdown percent. Keep on going on the stress test for the portfolio to show you the robustness of the portfolio, because it's good. You always need to consider a number of things when you are trading, when you decide to trade the portfolio. First of all, you need to do some stress tests such as Monte Carlo analysis, as I showed you, and of course how the things will go on real trading, possibly on the sim account on the early few months. But in this case, TradeStation produced the PDF only for the live account, not for the sim account. So this is really live trading simple. Back to the final test, I want to show you for exhibit the robustness of the portfolio is this interesting test, which is the predict equity curve. The entire portfolio counts more than 4,000 trades. Let's make this test, which is called predict equity curve over, let's say, less 10% roughly, with a confidence of 100%. And so if I run this test, it takes a while. Once again, it's running. All right, so let me see. All right, yeah. Now this test is something very interesting. By making a Monte Carlo test over the historical trades, assuming this random reshuffle of trades with a Monte Carlo approach over the last trades, in this case I say to the software over the last 450 trades, you got this predict equity curve, which says me how healthy is my portfolio. If the equity line is over this brown line here, then you are overperforming. If your equity line is much below this green line, then you are underperforming. In this case, you see is in between. So the behavior of the portfolio is in line with historical behavior. So saying that, doing some tests as I show you with some really live result over the strategy developed by these two excellent guys I mentioned you. We have a number of offer. If you have a specific, very specific request, visit our website, use our contact form, and send us an email. We are happy to, excuse me, we are happy to help you in order to offer you the best portfolio which fit with your demand, with your account size. All right, thank you very much for your attention, and hopefully you enjoyed, and we are here to assist you. Bye bye.